Hey there, welcome to the Money Movement. Today we're going to be talking about interest rates. So what are interest rates? Why are they important? Do they really grow your savings, and why should you care? Well, let's start with what are interest rates. Well, expressed as two things really, depending on who you are. They're the reward for people who have excess money and can save money into a bank account, and they're the penalty for people who don't have enough money and need to borrow from the banks. Now, if you want to learn more about the relationship between people who need to borrow and those who save, and how the bank link these two together, go and check out our video on fractional banking. It covers exactly this process, you'll be able to understand it. It's explained in a really simple way, and you should watch it because it's what the banks do with your money that's sat in your current account right now. What are interest rates? Well, they're paid on bank balances, and they can be paid in a variety of ways. They can be paid at the end of the year in one lump sum, split monthly across the 12 months of the year, split daily across the 365 days of the year, but most commonly it's usually quarterly or monthly they're paid. So how does it work? Well, you deposit £100 with the bank. They'll work out the annual interest rate and divide it by 12 and pay you 1/12 of the interest rate on the balance at that time. So let's say you had £100 and the interest rate was 12%. Let's make it really easy. So 12 divided by 12 months of the year, it means 1% a month. So £100 deposited today, after a month, 1% is applied to the account, which is £1. 1% of £100. And then moving into month two, you have £101 in the account. You get interest on the full 101, not just your 100. Now this is compound interest and can supercharge your savings depending on how high your interest rate is when the interest is paid. So if you want to learn more about compound interest, because it is a really, really important thing to understand in finance, go check out our video, it explains it, and you even get a nice link to Albert Einstein and the 7 wonders of the world, because he thought it was the 8th, and I tend to agree. How do you then compare bank accounts that have differing interest rates and differing payment amounts, and whether or not the interest is compounded over months or quarters or years? Well, the banks make it easy for you. They supply you with an AER, an annual equivalent rate. We've done another video explaining this in depth, but to all intents and purposes, it makes it easier for you to compare accounts from the whole of the high street where you can deposit your money. Go check out the video, it's really important. If you've watched all three of them and this, you'll have a really good understanding of how to make that money in the bank work hard, because you've worked hard to get it in the bank, so why not make it work hard while it's in the bank and get the best value for you? So interest rates are calculated, they're paid by your bank onto your balance. Over time, your balance increases because you might pay money in, salaries go in, stuff comes out, but hopefully at the end of the month you have a bit left and the interest is paid, and it all accumulates up into the bank account. Interest rates are paid to you if you leave money with a bank. Now, you can get high interest rates, you can get low interest rates, depending on how long you're willing to go without the money. So if you want instant access, you want to be able to get your hands on it like that, straight out of the bank, then you'll get a pretty low interest rate because the bank don't know how long they're going to have your money to lend it out. Oh, lend it out, you didn't know the banks did that? Go check out our video on fractional banking and it explains how. If you're happy and you think, you know what, I'm buying a car in a year, I'm not going to need the money before then you can do what's called a term deposit or a fixed rate or a fixed term account, where you give the money to the bank for a certain period of time. They'll give you a higher interest rate because there's more certainty around the length of time they're going to have the money for. So high interest rates, low interest rates, both of which can change. Interest rates can change and they're set by the banks, and the banks, all of the banks on the high street, take order and direction from the UK's central bank called the Bank of England. Now they set interest rates for a variety of reasons, but usually to help the economy stimulate and perform as they expect it to, because obviously their role is to get people employed, help people get the most out of their money, help businesses raise finance. So they have a much bigger agenda. They pass it to the banks provide products to you, and then all of us play the game and the economy moves in a direction the Bank of England want it to, which is low inflation, high employment, and good economic activity. So bear that in mind, interest rates can change. If you're on a fixed rate, they can't change for the term that you're on that fixed rate. If you're on an easy access, they can change at any point. The bank will give you a bit of notice, but they'll change almost instantly. So there we go, that's interest rates. So it's the reward for savers, the penalty for borrowers, but today we're talking about the reward for savers. Higher interest rates if you can tie your money up for longer, lower interest rates if you need instant access. Best way to compare interest rates, AER, annual equivalent rate. It's on your bank statement. Go online, plenty of comparison sites out there to find the best rate. And if you find a higher AER, take your money and move it if it's an instant access account, because you need to get the most out of every pound that you save. It will help you build good financial habits, and it will help you get to where you want to go faster, because it will make you more money. Who doesn't want that? It's free money. Bank accounts are all the same to all intents and purposes, so why not get the best one for you? And if you're worried that you're not getting enough money, well, compound interest will really help you. Go learn how that works. But with compound interest, your understanding of AER and general interest rates and how they work in the bank, you should be able to pick the best savings account for you to help you save for whatever you're planning to do. So there we have it, interest rates covered. I hope you enjoyed it. I hope you found it helpful. Please do let us know if you found it helpful in the comments. Please do also let us know if you didn't find it helpful. We are not precious and we want to put our contact that's going to really help you. So as always, reach out on the comments, social media, email, website, whatever you want to do, let us know and we'll put a video out on it and we'll hopefully help you make sense of all things money. But until next time, you take care. You got any part-time modelling jobs you want doing, mate? You just give us a call.
I wish you could see it from the other side. It's just like your upper face blurred out.
Is it?
Yeah.